Hello, what's up, guys? Hope you're doing well. So, my point is to cover a series or a playlist on current issues and the solutions surrounding it, the questions surrounding it, and how to approach. For example, in this video, I'm going to cover about cryptocurrencies and uh, the various reasons why it can't be considered under various IFRS standards, and which is the IFRS standard which fits it the most in different situations. And I'm also going to resolve a paper, the pre-March mock exam that was recently released on 7 Feb. And I just want to show you guys how exactly should we approach it, because it's going to be trendy. Maybe a lot of us don't know about cryptos, a lot of us do, and a lot of us are not really aware of the accounting treatment and why there is no specific standard around this, and which standard currently under IFRS standards are most suitable for this. So let's get started. I'm very excited. And if there's any doubt, please contact me on in the comment section, or you can also follow me on Insta, follow me on LinkedIn. The links are here as I have uploaded. And yeah, so let's get started. So, firstly, what is cryptocurrency? Cryptocurrency is basically like a digital currency, like which currently does not have legal tender in many countries, although there are some countries which do accept it, for transactions. But if you say like US, India, or any of these developed or developing nations, I don't currently think that it is accepted or even regulated by the central banks in such nations. So what we can say is that currently it's not legal tender, and it is therefore not fitting in various IFRS standards. So it's just a digital token that is being surfaced in blockchain. Blockchain is like that's like a platform where it's like stored, and backing the software that backs the cryptocurrency, and uh, where the digital token is stored, basically. So we can call it an asset because we can trade, we can get gains out of it, we also have risks out of it. But let's see, where does it exactly fit? So let's get started. I'll open the technical article page, and there we go. Yeah, so it cannot, however, crypto cannot be considered equivalent to any good or service, although increasing our acceptance in digital, but digital currencies are not yet widely accepted as a medium of exchange. Proving my point. IS7 defines cash or short term, highly liquid investments that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. It is subject to it is subject to significant risk of changes in value. That is the first part of cryptocurrency's definition, and not definition, I mean the whole ideology of it. Only when it keeps changing can we can get gains out of our trading, and we need to be very skeptical. It's highly risky. And is it liquid? Is it really liquid? Can we really convert it into cash? No, there's still a lot of skeptical about this, and clearly we can't. The answer is no. And for a financial asset at fair value through PNL in accordance with IFRS 9. So this is another thing, another part of the question: why it can't be regarded as financial asset? Because it is not, you're not. First of all, you're not even representing. It's not an equity interest. I said it's not a stock. You're not owning a stock of a company. Neither you're paying some cash here. So neither you have the right or the obligation to deliver cash or some other financial asset. So when it doesn't meet the definition of an asset or of a financial asset or a cash, how can you regard it as a financial instrument in the first place? How can you go and treat it as a financial instrument? Consider the fair value changes in fair value through PNL method and something like that. You can't apply whatever is applicable for our investments, equity investments or debt instruments or whatever investments we have made. So again, crossed out. Then comes our IS 38 intangible assets. IS 38 states that an asset is identifiable if it is separable or arises from contractual or other legal rights. And it is capable of being separated or divided from the entity and sold, transferred, licensed, rented, or exchanged either individually or together with a related contract, identifiable asset, or liability. So this is like basically defining the technical things. Separable, when it is considered separable, it is arising out of contractual legal rights, Yeah, so maybe there might be some, for each cryptocurrency, there is some, what we say, the paper, the white paper and stuff. And as you go and invest in it, you do have some legal rights to probably trade or to use as a digital currency in certain countries. So kind of the criteria is applicable. And at the same time, so which says that no, why are going to IS 21? And it does not have physical substance, non-monetary asset, and I mean it is non-monetary because it can't be readily convertible to cash, and we're not sure if we can just use it for buying things and stuff except for buying other digital currencies, so non-monetary. So it is fulfilling is 38 in many ways, so that's why it fits in. Now there are other standards are also that I want to cover. Then is 21, the effects of changes in foreign exchange rates, which states that essential feature of a non-monetary asset is the absence of right to receive or a fixed or determinable number of units of currency. So for foreign exchange also, if you want it to be applicable, just like the financial instrument criteria, there has to be fixed number of currency exchange. Number of units has to be there for currency exchange. You should be receiving that. But here, first of all, it does not meet the currency criteria itself. It does not meet the legal tender criteria itself. Maybe you can't use it for your goods transaction itself. So how will it be used for translating foreign exchange rates? Right. So again, this definition, this IFRS standard also fails. Next is ISRS is capable of being separated from the holder and sold or transferred individually and in accordance with IS 21. It does not give the holder a right to receive a fixed. First of all, you should have the right to receive a financial asset or to pay the financial asset to somebody. You're not paying, you're not doing either of those. So this is interlinked with financial asset definition under IFRS 9. Therefore, even IS 21 fails, right? Then cryptocurrency holdings can be traded on an exchange, and therefore there's an expectation that the entity will receive an inflow of economic benefits. Okay, cryptocurrency is subject to major variations. It is non-monetary in nature. Of course, like those variations are there in the currency, digital currency. And cryptocurrencies are a form of digital money, do not have physical substance. Most appropriate is intangible asset. You should be knowing this already. But if you have not read this article, I am urging you to read this. But however, I am here to decode it, so it's not hard. It's not hard at all. So, what is a measurement criteria? Everything is defined here. Cost model, intangible assets are measured at cost on initial recognition, subsequently measured at cost less accumulated amortization. Normal, like PPE, man. Come on, you know it already. Depreciation can also occur. Impairment losses are also there. Go and check value in use, fair value less cost to sell, value in use, and recoverable amount, whatever it is. Lower of both of them. And then using the revaluation model, intangible assets can be carried at revalued amount if there is an active market, and maybe for all cryptocurrencies it is not there. So if it is not, that also I will cover very properly. uh, Using the cost model, so clearly we can see that it has given a measurement criteria. But certain times it happens that you have the even if you don't have the active market, there's a principal market, there is the other what is the last market, what we say, most advantageous market. So if those two are also not there, then we can go for cost. We just have to see what is most feasible for us to obtain for its pricing, right? Which market is there. If none of the markets are feasible, we can't even estimate, we can't even do a basic estimate which is quite close to its fair value, then please go ahead with the cost model. Otherwise, you won't have any basis to explain in the disclosures. You have to disclose about it as per IFRS 13. So, gain or loss recognized in PNL. Wait, 1 minute. However, in revaluation increase should be recognized in PNL or the. For example, now if there is a loss, revaluation loss, like directly you find out there's no gain. Start year itself, you got a loss. Directly recognized in the PNL, because you don't have any revaluation reserve to, you can't do a debit balance for the revaluation reserve, right? So you recognize that in PNL. That's the logic here. And secondly, the decrease shall be recognized in OCI to the extent of any credit balance in the revaluation surplus. So if Yes, that's what I'm trying to say. Only if there is some credit balance. For example, some 50 pounds or dollars are there, and 100 is the revaluation loss. So only 50 can be recognized in OCI to be net off in that revaluation surplus. Remaining 50 will go in PNL. When only when you have something in the revaluation reserve is when you can net off the loss, which is why I'm saying only to the extent of what you have in the revaluation reserve you can recognize a loss in the OCI. Simple. If you don't have a revaluation reserve at all, there's no gains at all, please go and recognize in the P&L. Simple. Then IFRS 13 criteria for active market, and whether active market exists, definitely it does. There is Coinbase and all that. Uh, there's a daily trading of Bitcoin as it is easy to demonstrate such a market exists. A quoted market price is an active, most reliable evidence of fair value. And yeah, so if the active market is not available, go for principal market. Principal also not there, most advantageous market. All this should be chosen. If none of these is there, then go for the uh, cost model. That's There's no other choice. So you should have some basis also. Then it covers about whether the cryptocurrency's useful life is finite or infinite. Indefinite life, where there's no foreseeable limit to the period over which the asset is expected to generate net cash flows. It appears that cryptocurrency should be considered as having an indefinite life. Usually IS 38 does not have such assets which has indefinite life or something, but here we'll consider it as default. That's the default useful life, indefinite, and therefore it won't be amortized. Of course, cryptocurrencies, digital currency being amortized doesn't make sense. I mean, it's pretty self-explanatory. So you will test it for impairment just like goodwill, and impairment in the sense if keeping it in the firm does not produce the benefits anymore and it's better off to sell it rather than keeping it for the longer term or something like that, if there's some impairment indicator. Next is in case if you have the entity's business which is of specifically trading the cryptocurrencies, and that clearly means that their inventories are basically the cryptocurrencies, then of course you will follow IS2 or something like that, for IS2 for the definition and for the criteria to recognize it. For example, an entity may hold cryptocurrencies for sale in the ordinary course of business, and if that is the case, then cryptocurrency could be treated as inventory. So, lower of cost or NRV is what we'll recognize. If the entity acts as a broker trade of cryptocurrencies, then IS2 states that their inventory should be valued at fair value less cost to sell. So, we won't see cost. See, one is for sale in ordinary course of business. You're like just general sales you're making. You have bought a lot of cryptos and you're selling it. Another is you are a broker or trader. This is general normal course of business, okay, like long term you're just keeping it in the stock types, that types. Another is where you are a broker or trader, okay, specifically your work is to get profits, so you're continuously making sales. So for you the most appropriate valuation is fair value less cost to sell. You won't go for the cost here, you will just go for fair value because it will keep changing. So that is a valuation procedure at the year end in the balance sheet. That's how you're going to consider, right? And thus this measurement could only be applied in a very narrow circumstances where the business model is to sell cryptocurrency in the near future with the purpose of generating profit from fluctuations in price. Next is about presentation and events after reporting period. So if you see, there's no judgment and uncertainty involved in the recognition and measurement of cryptocurrencies. A certain amount of disclosure is required to inform users in their economic decision making. IS1 presentation of financial statements requires an entity to disclose judgments that its management has made regarding its accounting for holding of assets. In this case, cryptocurrencies, if those are part of the judgments in that had the most significant effect on amounts recognized in the financial statements. So uh, material judgments that can materially affect the decision making process. The investors would want to know what is the basis of recognizing these cryptocurrencies. You have recognized this as an intangible asset. What is the basis of recognizing them? What judgments have been used in their evaluation? Why have we used IS 38? All this should be there in the notes of the financial statements. And yeah, so any judgments should be justified. That's why I'm saying you should have an active market in place or some principal market in place to justify the inputs used for its measurement. And that's pretty much it. Then also, highest and events after reporting period requires entity to disclose any material non-existing events. So this would include whether changes in the fair value of cryptocurrency after the reporting period are of such significance that non-disclosure could influence economic decisions that users of financial statements make on the basis of financial statements. So there are significant changes. There is a asset that you own, cryptocurrency that you own, which has lots of changes, keeps fluctuating. It is not as stable as a stable coin. And uh, I forgot the name of the asset, but there are some cryptos like that. So for such cases, if there is a material change, right, and it has happened after the year end, so of course it's a non-existing event because there was no evidence of it happening at the year end or before the year end. It is happening after the year end. So if it is a material change, you are going to consider, you are going to make a disclosure. That's it. IST in events after reporting period wants you to make a disclosure so that the investors know that okay, this asset that the company owns, this intangible asset that the company has kept in the balance sheet, has got this material change after the year end. So we need to make the investment decision accordingly. Do we want to continue the firm with the firm? Do we have any concerns regarding it? Do we should we raise some concerns regarding it? Or if that it's significantly making gains, then should we increase our investment in the company? So all of this will be affected, all of this decision making process will be affected. And that's why ISTIN comes into the picture. Hope I made this clear for you. If you have any doubts, please DM me. Insta is there, LinkedIn is there. There is this comment section. Please, please, I'm telling you, please ask me questions. I'm totally open to it. And I just want to help you guys because whatever I went through, I don't want anyone else to go through. Because in my times, I was not that much efficient, probably. I just used to skim read this. But I believe that you should properly have a concept in your mind about all this because it's very trendy in today's times. It's not just a hypothetical thing now anymore. It is something which is relevant for the near future. So you should be aware of the accounting related to all this. That's all about it. Let's come back to our question and let's answer the question. So, my answer is here. So, you can see that here I have already made some inputs. I have already answered the question, but I'll explain you. It's nothing to worry. So, here we go. Where is the question? Yeah. I already discussed the reason behind this, it being an intangible asset and not a financial asset or a cash. So you should properly define what is the cash and cash equivalent. What is the definition of it? Its value fluctuates. It's not regulated by a central bank. Neither it's legal tender. And then financial asset also again define the what is the definition. It's not a contractual obligation to receive cash, to receive any financial asset, to receive ownership like in the case of equity, or neither you are having the right to receive it. Neither it's an obligation, neither you have a right to receive it as per IFRS 9. Because it's not considered cash, it's not considered equity. Explain that. Whatever I just explained you, explain that in proper, crisp, short, concise sentences, but it should not be as concise as what I have written, of course. And then intangible asset, identifiable non monetary asset, no physical substance. I explained this. You can either use cost model, revaluation model. I properly explained this. Please revert back, check it, no problem. Check it as many times as you want until the concept gets clear for you. Then comes my next question. Use Exhibit 2, discuss the steps that Jared should take to measure the fair value of the cryptocurrency in accordance with IFRS 13 fair value measurement at 31 March 2023, that is a year end, and briefly explain the impact of the fair value measurement on Jared's financial statements. So there's this quoted price, or I have written. So there are three levels of inputs that can be used. One is a quoted price in the market, in the active market, or in the relevant market. Second is the observable inputs. That is observable inputs of some other similar assets, not the same identifiable assets, similar asset. Please go and check the definition in the textbook. Third is unobservable inputs. This is just estimates. Simple. I have explained in simple terms. This is what it means. Maybe textbook has a very complex definition, but what I mean to say is this is broadly what it means. Now, write this first. Explain in your own words. Okay. Next, tell a bit about active market. Active market is one which is where the quoted prices will come up. This is the exchange, cryptocurrency exchange, where it's being traded, and a lot of frequency of transactions are high, volume is high. There's a most accurate price will be reflected there. Then comes the principal market. Again, there's a greatest volume level of activity, but not as much as the active market. Okay. Maybe some other cryptocurrency exchange where the trading is not as frequent as in the active market. But what I'm trying to say is that this is better than the advantages market, which just uses like other maybe which has a lot of restrictions, or which has other assets and their quotations, or which has same asset also but with lot of deficiencies out there. But it can give you the best possible price and with the least amount of transaction cost. So that is the most advantageous market. So we'll use that. Fine, this is concept is clear. Let's go ahead. Where's my exhibit? I'll just get my screen here. I'll go here. Directors be the measurement guidance in IFRS accounting standard does not provide relevant advice on cryptocurrency valuation to help them prepare the financial statements. After consulting the external auditors, the directors intend to account for the company's cryptocurrency holding using the revaluation model. Okay. So clearly, of course, it does not provide the IFRS standards, do not provide it. There's no clear IFRS standard discovered for it. It is just, we are just trying to meet the cryptocurrency definition with the definition of some IFRS standard. Wherever it fits in, we are fitting it there. There's no particular IFRS for it yet. So, using the revaluation model in IS 38 tangible assets, because auditors do not believe the cryptocurrency meets the definition of cash or cash equivalents. Correct decision, auditors, or that of a financial asset. On 1 Jan 2003, Jared purchased 1000 units of currency for 6500 per unit. That was the rate when they purchased it. The cryptocurrency is traded in several markets with different prices being quoted in each price market. As there is no single price for the cryptocurrency, Jared cannot access every market as some markets have restrictions which affect the trading of the cryptocurrency, and the markets are volatile and trade 24 hours a day. Okay, so good, well and good. Some definition about the market, but with restrictions. So I can say that here we have. I don't really think that it can. We can say that we have to go for the most advantageous market here. So even if there might be principal markets available for us, among all this list of markets, we would have to choose the most advantageous market for us, right? Because there's no specific market out there, right? So and we can see allows trading for value less than 10,000, and clearly 6500 1000 units value less than 10,000, that clearly means not high value transactions are not there. Frequency also might not be high of such transactions. It's not a principal market, so let's just not go for it. Trading in cryptocurrency needs a license which can be only obtained by financial institutions. Okay. Again, restriction is there. Trading in the cryptocurrency is on the derivatives market and is not subject to specific regulation. Okay. But it's not regulatory, but we can consider it. Trading the cryptocurrency is on the derivatives market and is not subject to, okay, same thing. Although there is no direct ban on the trading of the crypto, there are very strict rules which makes trading in cryptocurrency a difficult process. So although there's no direct ban on the trading of the cryptocurrency, there are very strict rules which makes trading in cryptocurrency a difficult process. So very strict rules, restrictive market, not the most advantageous market either. So I feel CND is the option that should be uh, checked on. And in the CND, we can see that more number of transactions are here, market size is larger, and price is also higher. So, in case if they sell or if they want to value and they want to find a gain on their valuation, because clearly 6,000 is the purchase value, 6,500 is the purchase value. Um, okay, there's no gain, but Among the two advantages market, we can see that 6,350 is more priced, right, for each per unit. So we have to go for that. So in terms of either lesser transaction cost or higher price per unit, you need to find out which is the most advantageous market, and in these two options this is the one fulfilling the criteria. So we'll go here and we will write it down. What was the initial 1000 into 6500, $6.5 million, and then I'm sorry, dollar came afterwards. uh, and then 1000 into 6350 is 6.35 million. So I can see there's a loss even in the most advantageous market, but we would have to deal with it. And so yeah, that's all about this. Write units of currency everywhere because it's important. Right, we did it. Cross and cross. So we have fulfilled the scenario requirements, and like this only you need to explain why we chose that. This is the most advantageous market. Whatever I explained you just need to write it down. See, it was that easy, na? That's what I'm saying. uh, do you want me to cover the next part as well? Discuss the benefits payable to employees because of a restructure. And yeah, so potential impact on investors again means that it is a current issue. You need to, find out sustainability issues. uh, there is some restructuring process out there. What will be the impact on the investors, on any other stakeholders, or even investors? Ethical investors raise concerns about environment, so we can write about that as well. So this is a current issue, and I will cover that in the next video, guys. Till then, please stay tuned, please subscribe, please like, please comment, please DM, do every possible thing to contact me. I don't mind, but only for the purpose of doubts, of course. And yes, hope you have a good day ahead, and please do like and share. Please, please, guys, genuinely, please, because I can only stay motivated if you like and share, and if you really find my videos you know efficient enough, and which has made you helped you to understand the concept. Thank you and have a good day, guys. Okay, bye.